Most investors think they already know which ETF is best for long-term dividend investing, usually the one getting the most hype online. But what if a $100,000 investment actually grows very differently in SCHD versus DGRO versus VYM than you'd expect? Today, I'm breaking down a clear, data-driven comparison of these three dividend giants. Stick around until the end to see which one comes out on top and whether it deserves a spot in your long-term portfolio. ETF number 1. VYM. VYM is Vanguard's high-dividend ETF. It tracks the FTSE High-Dividend Yield Index, giving you exposure to large U.S. companies with above-average dividend yields. Its goal is simple: generate higher income by focusing on established, cash-producing businesses. VYM is known for its low expense ratio of just 0.06%, meaning more of your money stays invested. Its top holdings include companies like JP Chase, ExxonMobil, Johnson & Johnson, Procter & Gamble, and Chevron. The fund leans heavily toward financials, healthcare, and energy, making it a classic income-first ETF. To put this into perspective, if you had invested $100,000 into VYM 10 years ago, and it continued delivering its historical average annual return of around 8.9%, your portfolio would have grown to over $234,000. On top of that, factoring in its current dividend yield of 2.59%, your investment would now be generating roughly $6,000 per year in passive income, without touching the principal. ETF number 2. DGRO. DGRO takes a different approach. It focuses on dividend growth, not just high yield. It tracks companies with a strong history of increasing dividends while screening out stocks with unsustainable payout ratios. Some of its top holdings include Microsoft, Apple, JP Morgan, and Visa. Compared to VYM, DGRO has more exposure to technology and growth-oriented sectors, aiming to balance rising income with long-term capital appreciation. Looking at the numbers, a $100,000 investment in DGRO 10 years ago, growing at its historical average annual return of around 13.1%, would now be worth over $342,000. On top of that, factoring in its current dividend yield of 2.1%, your investment would be generating roughly $7,182 per year in passive income, without touching the principal. That's the strength of combining growth with steadily increasing dividends. ETF number 3. SCHD. SCHD is one of the most popular dividend choices for a reason. It focuses on high-quality U.S. companies with a long history of reliable dividend payments, while also screening for financial health, strong cash flow, low debt, and consistent dividend growth, all at a very low 0.06% expense ratio. Its top holdings include Coca-Cola, Verizon, Home Depot, PepsiCo, and Broadcom. SCHD leans more toward consumer staples, industrials, and energy, giving it a more defensive, income-focused profile. To see its impact over time, a $100,000 investment in SCHD 10 years ago, growing at its historical average annual return of around 12.3%, would now be worth over $319,000. On top of that, factoring in its current dividend yield of 3.9%, your investment would be generating roughly $12,441 per year in passive income, without touching the principal. Part 4. Which ETF wins? After looking at the performance of these three ETFs over the last decade, we can see clear differences. DGRO has generally delivered the strongest total returns. VYM has provided solid income with steady returns but lower growth, and SCHD sits in the middle, offering a powerful combination of reliable income and respectable long-term performance. Each ETF plays a unique role depending on what you value most. Here's the key takeaway. There isn't a single best dividend ETF. Each one offers a different investing strategy. The smartest investors don't limit themselves to just one. They combine strategies to build portfolios that grow, generate income, and protect capital at the same time. If you enjoy ETF breakdowns, make sure to like and subscribe.